Hello, I'm Brian Zen. I teach investment analysis at St. John's University. I manage private and institutional portfolios at a New York investment firm. I have earned an MBA in accounting, a PhD in finance, and I have passed all the 3 CFA exams. In this study session, we talk about mortgage-backed securities, asset-backed securities, and commercial mortgage-backed securities. First, let's move on to the traditional residential mortgage securities. There are a couple of things we need to know about mortgage. First of all, there's a collateral involved. It's usually the borrower's residential real estate property that's put up as a collateral to borrow for that amount of loan. So you will need to look at the property itself to see if the collateral has a high quality or not. Secondly, you need to look at the borrower's credit. Can the borrower have the capability to pay you back? And if the borrower is borrowing too much based on the value of the property, let's say if the property is worth $100,000 and the borrower wants to borrow $90,000, the 90% of the real estate value, you would be concerned. You would try to reduce that to probably $70,000. And also, you need to take a look at how much of the monthly payment that the borrower will pay for the mortgage as a percentage of the borrower's monthly income. If the mortgage payment is a high percentage of the borrower's monthly income, you would watch out. Then you would also see how much down payment that the borrower is putting down. The more down payment, the better. Recently, as the housing market is booming, the down payment requirement is dropping from 25% to 20% to 15% to now approximately 5%. You know, in this situation, the mortgage securities would be of a lower quality. The quality of those mortgage securities is in a declining trend if the housing market booms. The important thing to know about mortgage securities is they have prepayment risk. The prepayment right is given to the borrower. So the borrower essentially have a call on the bond. Just like the corporate issuer, if they issue you a callable bond, the corporate owner has the right to call the bond and prepay you at any time when the interest rate drops. Here, you gave a call, you as the lender, you give a call to the borrower. If the interest rate go down, of course, you as the owner, you as the lender, you see interest rate went down. You lend it out at a high interest rate. You have a good thing going, but that can only last for 30 minutes because you gave the borrower a prepayment option. He can give you a call. He'll say, I want to prepay my loan, and then I want to go out into the market to borrow at a lower rate. So you would be facing a prepayment risk. We also need to understand here the cash flow characteristics of the fixed rate level payment fully amortized mortgage loan. What are those? Essentially, your monthly payment is fixed. And out of the equal monthly payment that the borrower pay the lender, there are 2 parts. Part of the fixed monthly payment goes to pay down the principal, and part of it pays for the interest rate cost for the borrowing. Usually at the beginning of the loan, the balance of the loan amount is large. The interest portion of that monthly payment will be big, and only a small part in excess of the interest payment goes to pay down the principal. But as the loan principal was paid down, gradually the interest portion becomes smaller and smaller, and more of that monthly payment goes to the principal pay down. So that's what you need to remember about a fixed rate, level payment, which means equal payment per month, fully amortizing. Essentially, your principal balance is going to start from the loan amount and gradually goes down at the end of the loan horizon. Your balance of the principal would be zero. It will be fully amortized. There are two risks involved with the mortgage bonds. We talked about the prepayment risk that's faced by the lender. And usually, in some countries around the world, there's a prepayment penalty. So essentially, if the borrower comes to the lender and want to prepay the mortgages that they borrowed, there's a penalty for that. But usually in the United States, the residential mortgages here do not contain prepayment penalties. So the borrower would have a good thing going for them. If the interest rate go down substantially, they would look for refinance to reduce their borrowing cost on their house. Now, let's take a look at how to form pass-through mortgage pools using the residential mortgages that's generated by the different banks. The key of the pass-through mortgage security is that the banks would lend money to the borrowers and let the borrower buy their residential property. All these mortgage pieces will be put into a pool. We pool all those mortgages together, and the interest rate payments, the principal pay downs, and the prepayments. Remember, the borrower have the right to prepay you whatever amount they want, and they can pay down the loan in whole whenever they want. So all these three kinds of payments, interests, pay down of principal, and prepayment, will all go into this pool. And all these payments will be passed through to the security investors of these pass-through securities. Essentially, this pool of small mortgages will be issuing paper certificates. And each paper certificates of those pass-through securities will own a proportionate share of this entire pool. And whenever this pool receives $1 million of prepayments, this $1 million of prepayments will be distributed pro rata to all the certificate pass-through security holders. Of course, the manager of the pool would say, hey, I would charge a service fee. And if this mortgage pool carries an insurance, the insurance company would charge a fee. Or if it has a third-party guarantor, to get the third-party guarantee, you would also have to pay a fee for that. So all the interests and the prepayments and the scheduled principal pay down goes into the pool, and all of these cash inflows get distributed, passed through, pro rata to the holders of the pass-through securities. The key thing of the mortgage pool is that we are converting illiquid separate pieces of residential mortgages into liquid securities that we can issue to buyers in the form of paper certificates. Of course, all those paper certificates is recorded electronically into your brokerage accounts. The key to understand mortgage securities is that all of them have prepayments. So when the interest rate go down, the prepayment will go up. So as the interest rate go down, the cash flow that you are going to receive by holding mortgage securities will be changing. So interest rate changes will cause cash flow changes. It's kind of the callable bond characteristics. So to value those type of securities where interest rate changes will cause cash flow changes. And when the cash flow changes, the value of your security also changes.